Hi everybody, again foreign currency transaction. In this video we will move to discuss the last objective of this chapter. We will explain the accounting treatment given various types of foreign currency hedge. As we discussed before, when we have foreign currency transaction, we aim to protect ourselves against the fluctuation of foreign currency exchange rate. To do that, may we enter into foreign currency contract, future contract, option, etc., as we discussed in the previous video. Also, you have to be careful if we are talking about recognized transactions. So in this case, we are talking about fair value hedge. It means that we will recognize the amount of gain or loss as period income. Otherwise, if we aim to protect ourselves against the fluctuation of forecasted transaction, in this case, we will recognize the amount of gain or loss as the other comprehensive income because we don't have recognized a transaction. To clarify these ideas, let us move to discuss this example. Utility has accumulated 10,000 barrels of oil in inventory. Already we have the inventory that it will not sell until the later winter months. Utility wants to maintain the value of the inventory. They want to protect themselves against the fluctuation of the inventory prices, which is recorded at cost of $85 per barrel in the event that the price of oil falls before they are able to sell it, because we fear of that the fluctuation of the prices or falls the prices or the price of oil falls before we able to sell it. So we entered into contract, to hedge contract on November 1st. Utility enters into future contract to sell the oil for $90 a barrel in 3 months. The contract will be settled net. Here on November 1st, we entered into forward contract to protect ourselves against the falls of or falling of the prices of oil. We entered into forward contract to sell our inventory by $90. Okay, so let us, how did the prices fluctuated during these periods? We entered into forward contract on November 1st, so we will settle it into in 3 months. So we will settle it. We will pass November, December, and January. We will settle it at the end of January or at the beginning of February. Here, the market price is given. The market price of the oil is $92 per barrel at December 30. At the end of the period, on the date of preparing the financial statement, the market price of the oil that we entered into forward contract to sell it on February 1st by $92. We have entered into forward contract to sell it by $90. Already we have sold it by $90, but the prices has increased into $92 on the date of preparing the financial statement. So inventory, we own it and we have sold it by $90. The question is, or the point is, the prices has increased into 92. Can I sell it by 92? No, because already I have entered into forward contract to sell it by 90. So because of entering into this forward contract, this means that we have lost because entering into this forward contract. Here, the loss per 1 unit is $2, as the difference between 92 and 90, the selling price is 90 and the pricing or the prices has increased into 92. So we are talking about $2 per barrel. So we have sold 10,000 barrels. So we are talking about $20,000. $2 multiplied by $10,000. Also, on the other hand, as we have the inventory, still we have it. So you have to reevaluate it as the inventory is associated with forward contract, so we will evaluate as according to the fair value. Here the inventory that we have it, the value of it is 90 in hand, but the prices has increased into 92, so it means we have gain. On the other hand of the forward contract, the mirror of the forward contract is the inventory itself. So here on the date of preparing the financial statement, we will recognize the amount of loss because of entering into the forward contract, and we will recognize the amount of gain because we will reevaluate the inventory by the market price. But be careful, as we entered into forward contract, so the amount of gain that result as entering into forward contract, we will calculate it by we will recognize it by the present value. So here the amount, as we discussed a minute ago, is 20,000. 10,000 barrels by multiplied by $2 in total $20,000, assuming 100% per month interest rate. So the present value of 20,000, the amount of gain because of entering into forward contract equal 20,000 divided by 1.01, as the interest rate, monthly interest rate is 100% per month, and we are talking about the remaining life of the forward contract is 1 month, as we prepared the financial statement on 31 December and the settlement date is the end of January. So here we are talking about the present value is 19,802. Let us move to see how we will record the accrued transaction on 31 December, and then we will move back to discuss the transaction on 31 January, the date of settlement. Here, as we discussed a minute ago, we have 20,000 as loss because of entering into forward contract, where the prices of sold inventory increase from 90 to 92, and we calculated the present value of this amount of loss. So loss on forward contract is 19,802. On the other hand, the forward contract will be credited by 19,802. On the other hand, we have to recognize the amount of gain on inventory as the value increased from 90 to 92. So the amount is 20,000. Inventory will be debited by 20,000, and we will recognize the gain on inventory also by 20,000. This is on the date of preparing the financial statement on 31 December. Let us move back to see what's the price on January 31. The spot price is 89. The spot price on the date of settlement is 89. It means it has been declined from where? From 92. This is the last settlement we adjusted on the date of preparing the financial statement. The prices has been declined from 92 to 89. So in this case, we have gain on forward contract. You have to record it as the prices declined from 92 to 89. And utility settles the contract by receiving 10,000, or the difference between the forward price is 90 and the prices on the settlement date is 89. So instead of pay the total amount and receive the cost, we will settle by the difference between exercise price of the forward contract, which is $90, and the spot price on the date of settlement, which is 89. So we will receive $10,000 as settlement instead of paying the receiving the total amount and paying the amount of forward contract. So here we are talking about receiving $10,000, the difference between 89 spot price on the settlement date and $90 the forward price. Let us see. Here we will recognize we have two transactions. the forward contract adjustment from 92 to 89. On the other hand, the inventory adjustment also from 92 to 89, and then we will recognize the amount of settlement or receiving amount of $10,000. So here we are talking about the difference from 92 to 89. We are talking about 30,000, but already we have recognized $20,000 by 19,802 as the present value of it. So in total we are talking about 20,000 plus 10,000, the remaining amount, the difference between 90 and 89, $3 multiplied by 10,000 barrels. So in total we are talking about $30,000, but this amount is divided into loss on forward contract that already we have recognized by the present value, and the 10,000 that we have gain it right now. So gain on forward contract equal 20,000 divided by 101, so equal 19,802 already we have calculated, plus the difference which is 10,000. So in total we are talking about forward contract is divided by 10,000. This is the difference from 90 to 89, and forward contract 19,802. So we have gain on forward contract by 29,802, that the prices has been declined from 92 to 89. On the other hand, as we evaluated the inventory on the date of preparing the financial statement by 92, right now the inventory in hand, the value of it has been declined from 92 to 89, so we are talking about loss by $30,000. So you have to recognize it. Loss on inventory 30,000, inventory will be credited by 30,000. Now at the end of this transaction you have to settle the forward contract. How we will settle it? Now we can sell the inventory and receive against the transaction, or we can settle the forward contract itself. Instead of selling the inventory and receiving the cash and purchase something else, so we can settle the difference between the exercise price of the forward contract, which is 90. So instead of receiving the 90,000, the 90 multiplied by $10,000, we are talking about receiving 90,000. We will receive the difference between the spot price and the exercise price. This is the difference between 90 and 89. Here we are talking about $1 multiplied by 10,000 barrels. So we are talking about $10,000. We will, to settle the contract, forward contract, we will receive in cash $10,000, and we will settle the forward contract by $10,000. Until now, I think in this video it's enough. In the coming video, we will discuss additional examples. See you there.